everyone. We're going to talk about how to read financial statements in 4 sections. First one is about income statement. Second, balance sheet. Third, cash flow statement. And fourth, forecast and budget. For today, we will cover how to read income statement. First of all, what is income statement? Income statement is a financial statement, tells you how much money you made during a period of time. And for this video, we're going to use January as an example. January 1st to January 31st, 2020. You probably will ask, what do you need income statement for? There are different reasons that you need income statement for. First, investor financial packages will require you to include an income statement. Second, when you go to a bank for a loan, the bank will ask you for income statement and balance sheet. And third, for you as business owner, founders, that when you make business decision, you need financial statements to back up, to analyze all the data, analyze the financial condition of your company, and then make a decision from there. And the last one, but not least, is you need income statement as a data source for tax filing. These are the 4 reasons why you need income statement for. Now we're going to talk about what exactly is included in the income statement. The first part is revenue. Revenue is the sales you made for that period of time, for January 2020. And this is the first session of income statement. So for the revenue session, there's actually 2 parts. First one is revenue, tells you how much sales you made, and then right underneath that is cost of goods sold. That tells you the cost associated with the sales that you made during that period of time. And they are in the first session of the income statement. The second session is called expenses. It lists every single expense you have for your company. Companies list the expenses during bigger categories. For example, salary and expenses. That is the expense that you pay to your full-time employees and the employment tax that you pay for them. That's one big category under expense. Second one, marketing and sales. These are the expense that you pay to market campaign, when you do trade shows or social media expense. These are the expenses that include in sales and marketing. Third one is office expense. That includes rent if you have a retail store or if you have an office. And the utility you pay, or also office supplies such as printers, laptops, monitors. It could also include, if you hire someone to clean the place or take out the trash, and the phone bills that you pay. These are all included in the office expense. Another big category is called depreciation expense. Depreciation expense is for fixed assets or any kind of assets you have that depreciates over time. So that's another big category for the expense on income statement. The last section of income statement is called net income. You automatically get to net income from sales minus expense to get to net income. So net income is the number that tells you how much money you have made during that period of time. Now we have covered the 3 sessions of income statement. First, on the very top, you will see revenue. And then the second session is called expenses. And the last one is net income. Net income is you get net income from sales minus expense, and you get to the net income. For business owners and founders who are using income statement to make decisions, you might have questions like, Can you get burn rate from income statement? Absolutely, yes. You can pick the expenses from income statement and get to your burn rate. And you might also ask, how often do you have to look at income statement? The answer is as often as you would like to. Usually, business owners, founders like to look at income statement on a weekly basis every Monday morning for the financials or for the sales and expense incurred from last week, or on a monthly basis. And definitely on the yearly basis, you have to review your income statement. That's how often you need to take a look at your income statement. And then from there, you'd ask, can you use income statement to monitor your expense and take a further step, control your cost? Definitely, yes. So how I would recommend you to control cost based on income statement is assign a person or a group, department to all the costs and expenses on your income statement. For example, as I mentioned earlier, you have salary to pay salary expense for full-time employees. The HR manager is responsible for any expense that incurred, any expense that relate to full-time salary, full-time employee's salary, and employment tax. So if anything big changes, if you see any big changes for the salary, for example, it reduced by 50K, or it jumped up by 10K, 20K, you will have a meeting with your HR person and ask, do we hire any additional person? Did we lose any people for the month? Right, so that's how you tie the number to the daily operation and then to a particular department. So take one step further, you might have a office manager who manage all the expense for the office, and you can assign that office manager to office expense that session. So you can go to your office manager and ask, hey, I see the numbers went up for last month. Did we buy more laptops? Did we buy a printer? That's how you associate the expense to a department or the group, a person in the company, and find out the activity in what happened within the company. Then that's how you use income statement to monitor cost and control the expense. You might also ask, how do you increase net income? You can increase net income by increase your sales or decrease your expense, or do both at the same time to increase your net income. And this is everything I want to cover for today about income statement. We have covered what is income statement, what is in the income statement, and how do you use income statement to make business decisions, or what do you need income statement for. Hope this helps, and then for the next 3 sessions we will cover balance sheet, cash flow statement, and the last one is forecast and budget.